All right, welcome back. Not a great day for the markets. We're going to show you the futures, very thinly traded at this hour, so take it for what you will, and they are mixed. All right, we know today was a tough one. But before you start calling your broker on your rotary phone, calling your broker, consider this eye-popping stat from our friends at Bespoke. It has now been 279 trading days since the S&P 500 had a 2% pullback. That is more than a year of trading days. And it's one of the longest streaks without a 2% pullback ever recorded. Big picture, investors like you still sitting pretty well despite the recent sell-off. But all good things may come to an end at some points. The question is, when do we get a meaningful pullback in the market? Because this ain't it. Let's talk about it with Kathryn Rooney Vera, Chief Market Strategist for StoneX. And, you know, we've been going up for so long that the fact that when your dad was a pilot, we were at 36,000 feet, we went to 35,000 feet to level off and people are panicking. But the plane is still flying pretty good. When do you think that we might get an actual pullback?
We're not going to get it while we have economic growth where it's at. 1 full percentage point above potential, which in the United States is 1.8%. So when the economy is growing at 2.8%, that's pretty robust. So remember in 2023, Brian, the beginning of 2023, the market was expecting 75 basis points of rate cuts. Didn't happen, but the market didn't care. Market rallied regardless, 26%. Why? Because the economic growth was so robust. So if 2024 is a repeat of 23 and we get economic growth remaining robust with a disinflationary process, the S&P 500 is going to move higher. And I'll point to one other technical factor, which is major breakouts. Major breakouts as defined by a new two-year high over the past, a brand new two-year high over in the past 1 year. The next year usually has an average of 15% return. So that's a major breakout. We've already seen record highs. So probably this is going to be a good year. My bet, and I've been saying this on your program, is hedge it. Hedge your bets, buy the put option, stay long equities. This is not the correction. The correction comes when we see unemployment jump and recession in the offing.
This is not the correction you're looking for. A little Star Wars reference. I will say this, Kathryn, which is, and I'm getting old, so I'm going to be the old man yelling at the cloud right now, and I've got a dirty secret to tell you and everybody listening and watching right now. 4.3% of the 10-year is not historically high. I know we think it is because we went down to 0 during the pandemic and we rode along at 2 and 3% for a long time. But to your point, if the economy stays strong, we can absorb a 4.5 or even 5% 10-year, I think.
Yes, and I'll add one point, which is outside of economic recessions, back-to-back earnings recessions are a historical anomaly. So we had one last year. We had a multiple expansion. We had 25% S&P expansion last year based on multiple expansion, expecting earnings recovery in this year. We're probably going to get it. I expect 8% expansion in earnings. And if we continue to see this economic growth, I think risk assets do relatively well. But this is not a rational market in my view, so it can end irrationally. My point, Brian, is protect your positions, protect your risk positions with cheap put options, with 2-year Treasury notes. The $6 trillion sitting earning 5.3% in money markets, that's unlikely to go to equities. That's more likely than not going to a complementary asset class, which is, in my view, the 2-year Treasury.
Just to your point, and you don't want to be a fear monger, but to your point about downside protection, it's not that expensive to buy a put. You know, just have a little insurance, if you will. And by the way, the next block, we're going to talk about why home insurance in your home state of Florida and others have gone crazy. But that said, we led the show off. I don't know if you saw the top with Halima Croft, which is Ukraine's going after Russia. Good, but it's heating up, not cooling off. Israel may go into Lebanon. It's heating up, not cooling off. Iran's all ticked off now. It's heating up. It's not cooling off. And China continues to saber rattle around Taiwan. We could wake up one day. We're one headline away, I think, from a 1,000-point drop on the Dow.
I couldn't agree more. Geopolitical risks are huge, and the repercussions are immense on inflation, on economic growth as well. So I do think there are underpriced risks that the market has woefully underpriced, and we would be smart as investors to bake into our portfolios. Yep,
that's it. And we are lucky to live here where we're sort of immune from the physical aspect of this, but not immune from, I think, from the fallout geopolitically from it. Kathryn Rooney Vera, really appreciate it. Thank you.
Thank you. Pleasure.
All right.